Welcome to the middle-class insurance trap, protecting assets when standard coverage falls short. In this video, we will explain how typical auto policy limits can leave a dangerous gap, why bodily injury liability is the real threat, and how an umbrella policy can protect both your current assets and your future earnings. We will proceed step by step and conclude with actionable measures you can take today. Let's begin. Here is today's agenda. First, we will outline why coverage gaps exist. Next, we will differentiate property damage from bodily injury and emphasize where the real risk lies. Then, we will unpack umbrella policies, including what they are and why they matter. After that, we will provide a clear action plan to close gaps. We will also include quick quizzes to reinforce your learning. Finally, we will summarize key takeaways and next steps. As a transition into our topic, consider that as your net worth grows, your exposure grows as well. Many standard auto policies cap property damage limits around $100,000, and while that might be adequate for most vehicle damage scenarios, bodily injury claims can escalate far beyond that. Therefore, as your financial life advances, standard coverage may not keep pace with the risks you face. Before we go further, a quick disclaimer. This video provides educational information and is not legal, tax, or financial advice. Coverage forms, limits, exclusions, and pricing vary widely by state, insurer, underwriting, and personal circumstances. Always consult a licensed insurance professional or attorney to evaluate your specific needs and policy language. Let's define the insurance gap. Property damage limits are often around $100,000, which is frequently adequate because relatively few single vehicles exceed that amount. However, bodily injury liability claims are the real danger. Medical expenses, lost wages, rehabilitation, and long-term pain and suffering can push judgments into the millions. When that happens, plaintiffs and their attorneys will look not only at your current savings and investments, but also your future income. The gap is the difference between the total liability exposure and what your base policy will pay. That difference can become a judgment against you, potentially leading to license or wage garnishment. This diagram walks through the real-world pathway. First, an accident occurs, and damages are assessed. On one branch, property damage claims are often limited and manageable, typically within $100,000. On the other branch, bodily injury costs can expand rapidly, including medical expenses, lost earnings, and non-economic damages. The primary insurer pays up to the policy's bodily injury limits. If the claim exceeds those limits, the remainder becomes your personal exposure, potentially resulting in a court judgment. That judgment can produce license or wage garnishment. However, if you have an umbrella policy, it activates after your underlying limits are exhausted and absorbs that excess liability, protecting your assets and future income. Similarly, uninsured or underinsured motorist coverage can protect you if the at-fault driver lacks sufficient coverage. Now let's focus on umbrella policies. The typical minimum umbrella policy provides $1 million in coverage, and for many households, the annual premium is around $750, though pricing varies. While that figure can feel high if your current net worth is under $1 million, the key is that umbrella coverage protects more than today's balance sheet. It also shields your future earning power. In a catastrophic judgment, courts may allow wage garnishment. When your primary bodily injury limits are exhausted, the umbrella layer activates, stepping in to pay above those underlying limits. In other words, this is not a luxury product. It is a practical, cost-effective risk management tool designed to prevent financial ruin. This table contrasts common base limits with real-world claim potential. Property damage limits around $100,000 are often sufficient. Bodily injury limits like $100,000 per person and $300,000 per accident, or $250,000 and $500,000, can still be exceeded by serious injuries. Umbrella liability adds $1 million or more of excess protection, activating after your primary limits are exhausted. Uninsured and underinsured motorist coverage should match your bodily injury limits to protect you if the other driver lacks sufficient insurance. Let's compare two scenarios. In the overcovered scenario, you carry an umbrella policy, maximize your bodily injury limits, and align your uninsured and underinsured motorist coverage to your liability limits. This greatly reduces the risk of personal judgments and wage garnishment, protecting both current assets and future income. In the undercovered scenario, you have no umbrella and low bodily injury limits, with UM and UIM possibly set lower than liability limits. In that case, a severe accident could lead to judgments you cannot comfortably pay, putting your earnings and savings at risk. This pie visualization shows how different layers contribute to paying a large claim. Primary auto bodily injury coverage pays first. Uninsured and underinsured motorist coverage protects you if the other driver cannot pay. And the umbrella layer absorbs the biggest excess amounts. The objective is to reduce the out-of-pocket slice towards zero by stacking coverage appropriately. This timeline illustrates a realistic path for improving protection. In year 1, audit your current limits and identify gaps. In year 2, increase your bodily injury limits and match your uninsured and underinsured motorist coverage to those limits. In year 3, add a $1 million umbrella policy. From year 4 onward, review your protection annually as your wealth grows and adjust coverage to track your risk profile. Here are your practical steps. First, list your assets and consider the present value of your future income. Second, maximize your primary bodily injury limits on auto and home as your insurer allows. Third, align uninsured and underinsured motorist coverage with your liability limits. Purchase at least a $1 million umbrella policy and consider higher limits as your assets and income rise. Verify underlying limit requirements and policy exclusions with your agent to ensure the umbrella will respond as expected. Finally, review these items annually to keep pace with changes in your net worth and risk profile. Quiz time. Which category is more likely to create catastrophic exposure for a typical driver? Option A, property damage at $100,000. Option B, bodily injury from serious accidents. Option C, comprehensive coverage for theft. Option D, collision coverage for your own car. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, bodily injury from serious accidents. These claims can escalate to millions of dollars because they include medical treatment, lost wages, rehabilitation, and non-economic damages, which can easily exceed typical base policy limits. Second quiz, true or false? Paying approximately $750 per year for a $1 million umbrella policy is an overpayment if your current net worth is under $1 million. Option A, true. Option B, false. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is false. An umbrella policy protects not only current assets but also future earning power. It can prevent wage garnishment and shield against catastrophic judgments that would otherwise follow you for years. Therefore, it is a prudent risk management investment, not an overpayment. Here are the key takeaways. First, bodily injury risk is the true threat to wealth, not property damage. Second, umbrella policies are essential risk management tools. Third, match your uninsured and underinsured motorist limits to your liability limits. Fourth, maximize your primary bodily injury limits and review coverage annually. Finally, when the downside is financial ruin, it is better to be overcovered than exposed. To summarize, as your net worth increases, standard policy limits can lag behind your risk. For a relatively modest annual premium, an umbrella policy can protect both your current assets and your future earnings. Close the gap by maximizing bodily injury limits, matching uninsured and underinsured motorist coverage to those limits, adding an umbrella policy, and reviewing everything annually. Thank you for watching. If you found this valuable, please like the video, share it with someone who needs to hear this, and subscribe for more practical financial protection strategies. I would also love to hear your experience and questions in the comments. Join the conversation.